Hello everyone, I'm Mark Kinney, Chief Investment Officer of Newport Private Wealth. For our third quarter investment strategy update, I'm going to primarily talk about two subjects, the public equity markets and a recent private equity investment we made. First, public equities. You probably know it's been a challenging year for Canadian investors. TSX performance was negative for the third quarter and is up just 1.36% year to date. Bonds, by the way, were also negative, off 1% on the quarter and negative on the year. Global stock markets fared a little better, but among major equity markets, there is just one standout, the U.S., with the S&P 500 up 10.56% through the end of September. Looking closer at that number, however, a different picture emerges. Just two stocks accounted for nearly 30% of the S&P's gains, Amazon and Apple. If you add in the other four FANGM stocks, Facebook, Netflix, Google, and Microsoft, these six companies are responsible for nearly half the U.S. market's gains this year. This is a very narrow bull market. All the rest of the stocks in the index are up only 3% on average. Not exactly stellar or broad-based performance, which is what you see in a healthier market. These six stocks now represent about 17% of the total market capitalization of the S&P 500. To put some historical color around these figures, back in the late 1990s, the top six growth stocks were also tech: Microsoft, Intel, Lucent, Cisco, Oracle, and Dell. At the very peak, their share of market cap was 17%, about the same percentage as today's six tech leaders. We've all been around long enough to remember what happened next. As interest rates began to rise, the dot-com bubble burst and the S&P 500 fell by 46%. Now to be clear, this is not 2001 and we're not calling for a significant correction. But as the saying goes, those that fail to learn from history are doomed to repeat it. Unfortunately, it is also sometimes the case that you are doomed to stand by helplessly while everyone else repeats it, which is why we are standing by with what we believe is a relatively defensive portfolio while still participating in some of the market's upside. Our allocation to U.S. equities in a balanced portfolio is 18%. The U.S. companies in our portfolio have excellent business models with significant competitive advantages, and they are executing on their operations beautifully. Talk to our managers, and they're very excited about the companies they own. Still, they are keeping their ownership positions modest and not overweighting any one company. Our total allocation to public equities in a balanced portfolio is 42%, towards the low end of our target equity range of 35 to 65%, reflecting our defensive posture. Another way we are defensive is we're carrying about 15 to 20% cash, which will protect capital and allow us to put money back into public equity markets at the right time. For now, we've been finding better priced growth opportunities in private assets. Within the two Newport equity funds, about 10% is allocated to private equity and infrastructure. Let me give you an example of an investment we recently made that illustrates how we access, analyze, and participate in these opportunities. Last month, we committed $20 million to Brookfield Capital Partners V, the newest flagship global private equity fund of Brookfield Asset Management. Brookfield is a world-class leader in private equity with an excellent track record. They have a phenomenal business model that generates a continuous flow of global investment opportunities, and they have top-notch operational expertise that they apply to the businesses they invest in. Brookfield Management generally invests their own money for 20 to 35% of the fund, thereby aligning their interests with investors like ourselves. It's rare to see that meaningful a level of participation and alignment. Once Brookfield buys into a company, its management goes in and applies its operational skills to create value over time. The more operationally complex, the better. It is the nature of the investment that there is a lag between the time of investment and value realization. One should not expect changes in value from quarter to quarter, as is sometimes the case with public equities. Returns are better measured over a couple of years. The Brookfield investment is an institutional-only fund, meaning it's not available to high net worth individuals or smaller pools of capital. Because we have a history of investing with Brookfield, we do so on better terms, which also helps our overall return. This is just one example of the size, scale, and quality of private equity investments we can access to provide growth and offset public market risk. The next slide depicts our yield asset classes, those that produce income primarily, but may also have a component of capital appreciation. You can see we have diversified sources of income. We're also showing the current running yield associated with each asset class, which is helping us to earn positive and steady returns in this higher risk, low return environment. In a year when pickings are tough, bonds are negative, our domestic market is flat, and we're not comfortable with the risks in the US market, we're happy with our relative performance. We would just like a little more. Each of our 5 portfolio mandates are outperforming their benchmarks year to date, but at lower returns than we've been able to achieve in the past. In the meantime, we can't say it enough. We appreciate your commitment to us and our investment approach.